Good evening. It's Saturday, March 9th. My name is Dave Coker, and this is Talking About Finance. And all right, it's going to be a great night. So let's go. Let's talk about two different investors. Both want to become financially independent. One follows the standard advice you'll find on the internet everywhere. He buys indexes. The other thinks a little differently. Avoids indexes. In fact, avoids anything that doesn't pay him to own it. Both invest the same amount of money every month, perhaps from their paychecks. But the dividend investor gets a boost. Of course, he invests his pay, but he also gets dividends every month that are also invested in more shares. Which investor's portfolio grows faster? Oh wait, there's more. We know about every 3.5 years, there's a bear market. In other words, declines, and sometimes sharp declines in the price of stocks. In the past, the S&P 500 has dropped as much as 53%. The NASDAQ has dropped as much as 84%. But we know share prices have little to do with dividends. So yes, dividends are still paid. And we also know that share prices of dividend-paying stocks fall with the rest of the market. But guess what? Not as much as the rest of the market. Each investor continues to put their money into the market, their paycheck. But the dividend investor also gets a boost from reinvesting dividends over a long period of time, regardless of market conditions. Neither investor has a certain path, but one has an edge. The free shares his dividends buy for him over time. It's something to think about when you engage the markets. Getting rich the slow way, the lower risk way, is something you should consider. So with that said, let's talk about finance. The S&P 500 dropped 0.26% last week. 8 sectors outperformed the index, with utilities and real estate taking the lead. And that's 2 weeks in a row for real estate. Interesting. 4 sectors underperformed the S&P 500, with discretionary coming in last, down 2.55% week on week. The VIX traded up on the week to 14.74. It started the week at 13.11. The 10-year note closed the week at 4.80, down 0.1% on the week and up 0.2% year to date. Oil closed the week at 77.84, down about 2.7% on the week and up about 8.6% year to date. So guys, today is Saturday, meaning yesterday was Friday. I'm quick that way. Yesterday was Bitcoin day in my household. Just keep buying once a week, the same amount every week. No slam purchases for me, just steadily stacking the sats. So let's take a look at what me and my buddies, some 50 or so finance professionals from all around the planet, talked about last week. And before we proceed, allow me to introduce ourselves. We are Global Wall Street. And between Telegram and our personal networks on LinkedIn and WhatsApp, we know everyone, absolutely everybody, in global finance. And this week we're reporting from the City of London. We're reporting from Shanghai. We're reporting from Tokyo. We're reporting from Jersey City. And we're reporting from Frankfurt. We have people everywhere, absolutely everywhere that matters. 7 slides for 7 days. Let's go. Let's get out there and smack that market up. Smack it up, up, up. Don't let it fall. Now that's the spirit. So when we take a look at what's going on in the markets, yeah, it looks like one of these big newscasters in the States is getting rid of all their stock analysts. Of course, they don't say who they're replacing it with, but, you know, they could replace them with kittens. Because analysts, especially mainstream media analysts on television channels, they have absolutely horrible records. Totally incredible. In fact, some of them, Mr. Kramer, for instance, is well known as a contrary indicator. Whatever he says, the market's going to do the opposite. So keep that in mind when you listen to news, when you watch telly, and they're offering up their advice. And when we talk about forecasting the markets, trying to understand what's going on, we do have this science, pseudoscience some call it, I tend to believe in it in a fair amount, called technical analysis or charting. And guys, when I studied it, charts are relatively simple. But these days, we've seen all these people getting into the market since 2019, 2020, 2021 or so. A whole bunch of people have come into the markets, and they, of course, consider themselves experts. And an interesting thing is when they do charting, when they publish charts, you know, charting, as I practice it, and I do look at charts from time to time, I just don't talk about it incessantly because the markets are inherently quantitative. But when I look at charts, my charts are relatively simple. 2 or 3 indicators, that's it. Spot price, moving average, RSI, maybe 2 moving averages, 50-day, 200-day, and relative strength index, that's it. But these people, they have nothing. They know nothing. They're trying to outdo each other, and they make their charts so complicated. It's not uncommon now to see 500 or 1,000 words explaining the chart, which, by the way, I was taught is supposed to be self-explanatory. You're supposed to look at it and understand. Maybe a paragraph, but certainly not 1,000 words. It's absolutely amazing what goes on in there. And we've got a new way to view the stock market, or more critically, the time value of money. And yeah, if you're like the 2 investors, the one investor we described at the outset, the patient guy, just putting money in periodically, collecting dividends, reinvesting those along with the money, you're going to do fine. It's the impatient investors that go in for these highly volatile but high growth indexes. I'm thinking of the NASDAQ and the QQQ. And they're just going into it. They don't really understand what's going on. They weren't in the markets 20 years ago. And things changed drastically about 15 years ago, right around the time of the global financial crisis. The Fed started pumping lots of money. Well, those days have come to an end. They don't realize it yet, but they don't understand. They look back. They don't look forward. And if they try to look forward using their charts, they're not credible. They just don't know what they're doing. When we look at what's going on with the Fed, when we look at actions of the Fed, if we look at statements from the Fed, if we look at the supply of money, if we look furthermore at inflation, they can't keep doing what they've been doing for the past 15 years. It's totally out of control. So they're going to rein it in. I'm pretty darn sure that'll happen. But regardless, we can always ask the consultants. Now, I used to work for a consultancy, and the game plan there was not just to avoid being pinned down as much as possible. So you call someone, financial firm calls in the consultants, and they send over a bear and they send over a bull. Here we go. Let's get the opinions out of the way. Yeah, it sort of works there. Oh, and we got to do 3 slides on Bitcoin tonight. This is from an article I wrote. You can find it on the internet. And yeah, we've surpassed the old record high in nominal terms. Of course, my theory is it should be up into about 77,000 in inflation-adjusted terms. But let's not worry about it. We can see right now we're tracking, decidedly above that. And the question is, how much higher can it go? Well, that's a really fascinating question, guys. It's one that bears a lot of talking. We'll come back to that in a moment. Because the upside, I think you might be surprised exactly how drastic Bitcoin could go this cycle. But first, we have a time machine. I just like this one so much, right? And what would your present self say to your younger self when you think back to the year you first heard about Bitcoin and said, right? I did start buying Bitcoin shortly after that. So I even though I could do a smack, I could get a smack. It's not as bad as some. But regardless, the answer to the question, not my presentation. The model is quoted up there or @ up there. You can find out. But what he's doing is he's using stocks to flow, and he's using a couple other models, putting them together, taking a look at the current price, 66. He forecasts by October 20th of 2025 that spot will be between 133 and 483. That's thousands, guys, by the way. So yeah, all I can say is keep stacking the sats. Keep buying. Buying regularly. Oh, and avoid the slam buying. My God, people always try to make up for lost time. You're really just better off putting the same amount in all the time. If you're just getting into Bitcoin, I guess you could make an argument to buy a whole bunch now. Actually, I do know a guy at a bank that I've been talking to him off and on for a bank, and he got a hold of me. He said, Dave, I got to talk to you. I said, what? He goes, I bought it. I said, what'd you buy? He goes, a Bitcoin. I said, you bought a Bitcoin? He bought a Bitcoin. Hope he's happy with his purchase. I think he will be, though, just between us, right? I don't think there'll be any problems there. But yeah, look at the upside, guys. Hypothetically, of course. But there's a reason why big Wall Street firms are getting into Bitcoin all of a sudden. 133,000 up to roughly 483,000. Take a look at your stack. Do the math. Oh, yeah. That's it, guys. I hope you had a wonderful week. Wonderful weekend so far. And next week's going to be awesome. We're all going to make a bucket of money. Because that's what life's about, isn't it? Take care, guys.